If you have ever been turned down because you could not document income, I want you to stay here with me for the next 10 minutes. Because the assumption that every mortgage requires income documentation is simply not true. It's true for conventional loans. It is not true across the board. I'm Toni Taylor, Senior Loan Originator at Interconnect Mortgage in Palm Beach Gardens, Florida. I have been doing this for over 30 years and I specialize in non-QM lending, which includes a program called a no-doc or a no-ratio mortgage. Today I'm going to explain exactly what a no-doc loan is, who it's built for, how the qualification actually works based on real program guidelines, and how it's completely different from bank statement loans, 1099 loans, and stated income products that caused problems back in 2008. Let me start with the most important clarification because this is where a lot of people get confused. A no-doc mortgage is not a bank statement loan. A bank statement loan still calculates income. It just uses deposit history instead of tax returns. There is still a debt-to-income ratio. Employment or self-employment is still part of that picture. A no-doc loan is different. There is no income anywhere in the file, none listed, none calculated, no DTI to run, no employer verified or even listed on the application. This is sometimes called a no-ratio loan. The reason it's called that is because there's no ratio. There is no debt-to-income ratio because there is no income to compare the debt to. You qualify on exactly two things: your credit score and your verified liquid assets. That is the complete picture. This program exists because a real population of creditworthy borrowers cannot document income in the conventional way. The most common scenarios I see are retirees who have built significant wealth over 30 or 40 years, investment accounts, savings, retirement funds, but they're no longer drawing a paycheck. A conventional says no because there's no W-2, but the assets are absolutely there. Business owners who have sold a business, they walked away with real money. They are not currently employed. They have no income to document, but they are not broke. Far from it. Investors who live off portfolio returns or dividends, that income does not present cleanly on a standard tax return. A conventional underwriter cannot figure out how to calculate it. A no-doc program sidesteps that entire conversation. High net worth borrowers who have structured their finances in a way that is smart for their tax situation but makes traditional income documentation impractical. And foreign nationals with U.S. credit and U.S. assets who simply cannot provide U.S. income records. If any of that sounds like you or like someone you know, keep watching. Since income is not in the equation, the entire file is built on credit and assets. Let me walk you through both. On the credit side, this is more accessible than most people think. Programs I work with allow credit scores starting at 620. The credit score determines your max loan to value, which determines how much you may need to put down. At 740 or above credit score, you can go up to an 80% loan to value. That means 20% down payment on a purchase. At 720, you're also at 80%. At 680, you're at 75%, so that's a 25% down payment. At 660, you drop to 65% loan to value and you're going to need a 35% down payment. At 620, you're at a 60% loan to value and you're going to need a 40% down payment. The better the credit score, the better the loan to value, the less you put down, and the better your rate. Your credit history needs to show that you're a reliable borrower. That is what the lender is reading in the absence of income. On the asset side, you need to cover three things: your down payment, your closing cost, and your post-closing reserves. Assets that qualify include checking and savings accounts, money market accounts, investment and brokerage accounts, retirement accounts including 401ks and IRAs, and business-based accounts based on ownership percentage. Cryptocurrency is eligible once it's converted to cash. Here is something worth noting. Retirement accounts count at 100% of their stated value for reserves under these programs. There is no haircut applied to retirement funds for reserve purposes. Assets need to be seasoned in your account for at least 30 days. They need to be in your name and they cannot be borrowed. Gift funds are acceptable for down payment and closing costs, but they cannot be used for your reserves. On reserve specifically, if your loan to value is 75% or below, you're going to need 6 months mortgage payment and liquid assets after closing. If your loan to value is above 75%, that number jumps to 9 months. And first-time homebuyers have a 2-month reserve requirement. I'll address this directly because it comes up every time I explain this program. The no-doc loans from before 2008 let borrowers write an income number on the application and nobody verified it. Loans were approved on a number somebody made up. That is not what this is. Today's no-doc programs are fully regulated. The difference is that instead of verifying income, the lender verifies assets. Everything is documented and third-party verified. The qualification factor is just different. These are legitimate, legal, fully compliant loan products. Interconnect Mortgage is licensed in Florida, Georgia, and South Carolina, and we operate under full regulatory oversight. Being straight with you on the trade-offs. Down payment starts at 20% for the strongest credit profiles and increases as the credit score decreases. At 620, you're locking in a 40% down payment. That's a significant commitment, but for borrowers in the right situation with the right asset base, it is entirely workable. Yes, rates are higher than conventional. That's the honest reality of non-QM lending, and I would rather tell you that now than have you be surprised. But the gap has narrowed as this market has matured, but it is real. The trade-off is access. If a conventional loan is not available to you because of how your income presents, a slightly higher rate on a product you can actually use is not a bad trade. On property types, this program works for primary residence and second homes. Loan amounts can range from anywhere from $100,000 to $3 million. We don't put investment properties in this program. If investment property financing is what you need, a DSCR loan is probably the right conversation instead. So, if you have solid credit and meaningful liquid assets but no traditional income to show a lender, you have options. And here's what you want to do right now. Download the free home loan document checklist at interconnectmortgage.com/preapproval-checklist. It will show you what asset documentation to start gathering before we talk. Then book a free 15-minute strategy call with us at interconnectmortgage.com/calendar. Come with your general sense of your credit score and what you have in liquid assets. You'll leave the call with a clear picture of whether this program works for your situation, what loan amount you're looking at, and what your next steps are. No pressure, no commitment, just straight answers about whether this program fits. I'm Toni Taylor at Interconnect Mortgage in Palm Beach Gardens. Links are in the description. Let's get you home.